Hi, everyone. I'm Rick Bensignor, and welcome to this week's In the Know Trader Show. Lots going on this morning, especially in the markets. So we're going to take a look at the S&P. We've got some news out of our government that it looks like they're going to delay the tariffs on China from September 1st, or at least on many of the items, and the market loves that news. So as of now, when we're recording, we've got the S&P up some 50 points or so. The Dow is flying also up 468, and gold has done a complete turnaround from being up a chunk this morning. It fell. It's now down about $10, but that's about $15 off its low. And for those of you who follow silver, it has unbelievably a 98-cent range today, which is just huge for those who trade silver. So today we're going to take a look at the S&P, especially given today's news and the complete turnaround. And then what I wanted to do was also this week look at the 11 S&P macro sectors. We've looked a lot inside of sectors, and we get down to individual stocks most weeks as we pick apart a certain sector and often take the largest cap names or the most widely held names and dig into the individual charts of them. This week, I thought, given how much the market's moved, let's take a look at the 11 sectors. All right, so let's first take a look at the relative performance of the 11 macro sectors to the S&P itself. This comes from StockCharts.com's performance charts, and these are laid out really nicely pictorially because rather than just looking at a spreadsheet, here it's very visual, and I like this a lot. So if you look at the far right-hand side, we see that real estate has now gone ahead of technology and is outperforming the S&P by 13.8%. Tech is about 11% above. The two worst performers have been the worst performers for, I'd say, 99% of the year. That's healthcare, which is now only trailing by 7.74%. So that's actually improved itself over the last month or so. And the continued dog of the S&P remains the energy sector. It is trailing this year's S&P overall performance by 13.3%. Again, last Friday's close was the worst close of the year versus the S&P. And if you pull up on your own a relative performance chart of energy versus the S&P, we are on 19-year lows, making for this sector to be a complete dog. Certainly over the last 10 years, because this peaked 10 years ago versus the S&P, only twice in the last 10 years has energy outperformed the market, and it is getting closer and closer to the all-time low since XLE, the ETF, has traded, which started, I believe, in 1999. So again, there are pockets of energy you can occasionally look. You can make money being long energy if you pick the right names. But it's clear, not only from this chart, but from what I just described over the last 10-year performance, you'd make a lot more money being in any other sector of the market than the energy space. Let's now switch over to our charts. And before we get to the sectors, let's start off like we always do with the S&P. And so here's a look, and I'll blow this up a bit. So you can see the big run up. We're back to 2940 or so, kind of where we remember the old highs were from. If I drag us left, 2018, the early highs were 2941. We slightly exceeded them in May. We then definitely exceeded them into the summertime rally. But as we've said before, we told clients 3032 was our upside target since the beginning of June. We got to 3028 on the peak of the move. We told people to take down your exposure, and we've seen a decline. I actually, even yesterday, was telling institutional clients to take a little more off the table, and then, of course, you get this news out today, which makes that look like a bad call. And this is something that we've talked about certainly in the No Trader all year long, which is when you have a president that tweets or kind of just does things at will, you're going to have more volatility in the market. And today is a perfect example of the S&P flying on a new headline that potentially changes the game again. So count-wise, we're on a setup for up today. That means today is the fourth day in a row that the close is above the close from 4 bars back. These often come in groups of 9. So we'll watch to see whether or not this extends to the upside or not, and that there's continued follow-through. Notice from the cloud chart, not only did we bottom into the cloud over last week, 3 days in a row. You basically look, this close here on August 5th was just a hair beneath the cloud. The next day, bottom at the bottom of the cloud, close near the high of the day. Again, a spike down, close near the high of the day. So not only has price action, for the most part, held its cloud, but the lagging line, which is this blue line, which is nothing more than current price pushed back in time, 26 bars, and we're looking at the daily chart, so it's 26 days, it also held and didn't break beneath its cloud. So short term, this has now got enough to offset the 13s to essentially be somewhat neutral, especially given today's headline. If I flip this to a weekly chart on the S&P, again, we had 13s on the high. The propulsion level at 2880, which is what we've keyed off of, has not been broken in a qualified and confirmed fashion. And for those of you who follow our work, you know that we don't just care if a level breaks, it's how it breaks it that is important. Another example of this is if we go back to May on a weekly charts, you tuck the hairline underneath this line. Even when you broke it this week, it did not break it properly. And therefore, we didn't get bearish on the break of 2,800. And this propulsion level still ultimately told us that if we got through here, you would get to 3032. And that's, we got 4 points away. The cloud model's baseline is this orange colored line here. We've held that now 2 weeks in a row on the lows. And we can't see where we're trading now just simply because this black line is covering where price is right now, this horizontal black line. But you can see here off to the right side, we're essentially at 2940. So in the scheme of things, we have a short-term pullback. If anything, what this told us was you don't want to be a buyer in the uptrend. And for those of you who know a little bit about DeMarc's work, when you trade off of 13s, when Tom set this model up, the way he set it up, and it's been somewhat misinterpreted over time, is that this would identify a bad time to be a buyer in an uptrend. This identified a bad time to be a buyer in an uptrend, and for a month we sold off. This over here on the far left, bad time to be a buyer, and I'll circle it just so you see which one I'm talking about, bad time to be a buyer in an uptrend, 2 very strong down weeks. Now, is this model always right? Absolutely not, but it is a much followed model in the institutional community. In the No Trader, the website and subscription model that I have set up is set up to give listeners, individual retail investors, access to models they would not normally have access to. And that's why I include it as part of the analysis we do. Plenty of institutions trade off of this, and that's why it is one of the models that for 20 years, over 20 years, I've been using and incorporating into the work I do. So the S&P, when I look in a strategic point of view, it's still bullish. Despite the 13 being here, we haven't broken down to go into a significant hedge position. We have not hedged books for medium-term investors yet. All we did was stop buying. Short-term, today's strength, again, neutralizes even what I thought could be a further breakdown, but today's headline changes that. So you kind of have a near-term neutral spin on the market and a cautionary bigger picture where right now I'm just content with holding what we have and waiting to see how things develop too. If we were to take out 3032, the next bigger upside target is up at 3184. I can switch this back to the daily, and you will see here that 3184 becomes the next target on the upside if we make new highs. And that's that on the S&P. So now let's take a look at the individual sectors and see what we can gather from them. So let's start with, we'll kind of go through the 11 spider charts, just alphabetically, starting with materials because it's XLB, and that's the first. There is no XLA. So XLB is the materials spider. And just so you get a sense here, the purple line is the 50. These are all weekly charts. That's the 50-week moving average. The green line here is the 200-week moving average. The rest of the colors are mostly from the cloud charts, except for some of these horizontal lines. But the gray and the pink here are all part of the cloud. So let's take a look kind of what we see. Since the December bottom, this came all the way back to break through its declining cloud, which was good, but notice the lagging line hasn't gotten through its cloud. So this never got a full upside bullish signal. It got you to be not short, but the cloud model didn't get you to fully, I'll take it back. You did get long, but you're kind of in the same place you got long. It needs to break through here to add more. You'd get a target up at 61 coming from the propulsion model. That said, if we broke 54 to the upside, and we break it correctly, which we did, you would target 61. So that's our next kind of general target. Of importance, too, is that the early 2018 high is still the high. So we're going to see some of these 11 sectors that have made new highs this year. Materials haven't come close. But, of course, up until today's pullback, the metals, especially the metals piece of materials, have been rallying nicely. A lot of people have flown into gold. Today is kind of a real pause day because gold itself has, let's see, 46 and 11, $57 range in gold today with a big reversal. So that could be gold's high for a while now. And you can still see that even though we've broken above the downtrend line from the highs, we still haven't really gotten the upward thrust here. So I would look for this count to ultimately finish out a 13 count to the upside. You should have some pause near 61, and challenging the all-time highs near 64 are not quite in the cards yet for this. Let's look at, so after XLB comes XLC, the communications. And this is not going to have a lot of price history because it was new. And, this was just developed last year when they added and rejiggered the sectors. So most important here is the 13 count, which came in similarly to the S&P itself, basically on the high of the move. It now has a potential double top versus its what had been its all-time high from last summer. Again, there might have been a higher high if you went back earlier last year, but I don't have the data for that. So we have a basic uptrend that's still intact. So if we take the Christmas low, that the recent decline last week still held above that, but you're kind of still in no man's land here, other than the general uptrend and a rounding bottom that we see from here. So this is, I'd say, mild bullish structure. Timing-wise, still would suggest that there's a potential pause here, and anywhere from in the low 50s up to these targets here, 54.29 to 54.42. So let's just say 54.25, 54.5. You're still within the context of this 13 and the propulsion target. That is, it's not a runaway buy signal yet. So I still expect some back and forth all the way up to the 54 level here, which makes it tough. What's more defining is, let's see, if we were to take out, if we were to get Friday closes, one or two Friday closes underneath last week's low of just about $48, just a penny's $47.97, the official low, you get under the trend line, you have already a propulsion bear signal that's in place that hit its initial target, but the secondary target would be down here at 44.86, which also over the next couple months would be where the top of the cloud is. That's just starting to form now. The reason you don't see the cloud is there's just not enough price data to create the whole cloud, but at least we see where the top of the cloud is. So again, somewhat neutralish in here. We could rally, but there's still high risk implied in first buying this here. Rather be a buyer on a pullback. All right, let's move on. Next is Energy XLE. So what's interesting here to me, and I'm actually going to take the cloud off because the cloud in this time frame is not helpful. Oops, let's why is, don't you love when computers don't do what you want them to do? There we go. So here's the picture of XLE. And to me, what stands out the most out of anything are the following. October of 2016, upside exhaustion signal. August of 2017, downside exhaustion signal. Rallied into a setup 9 up. This 9 count here is now created, and you need the 9 count to create the 13. Energy is actually saying that you could buy the XLE with a stop under 55.79. That's the way I would look at this. Here's your propulsion target. You just missed getting there. If you look versus old lows and look where, so here's the lowest low back years ago. Where did it close that week? I'm going to draw a line straight out from this close. That close essentially got the bottom at Christmas last year, and pretty darn, we didn't miss by much now, and I'm getting a 13 signal. So energy, we're towards the lower end of a couple-year trading range. It's the way I look at this is it's probably not a good time to be a seller, and it may be a good time to be a buyer. So I'd be more inclined to be a buyer of energy, despite the fact that we started off talking about how bad energy was. And I'm not saying it's going to outperform the S&P, but just looking at the XLE itself, in fact, I see another kind of, oops, put this on an ellipse. I see even back here, we had a 13 and 9 signal. Still playing with. Well, here you can see it here with my pointer. 13, 9, a little early, but still got massive bounce off of it. So looking at that, we're close towards support over the last several years, and getting a downside exhaustion signal at least gives me a little bit of sense. It's too late to be selling energy. I'd be apt to either sell a rally into resistance or nibble even on the long side here and play for a possible bounce in the sector. What you wouldn't want to see from the current almost 56 level is probably a couple of Friday closes under this level here, which is 52.62. That would not be a good thing if you were looking to buy XLE. So that's what we got here on the energy side. XLF financials. All right, so financials certainly having trouble simply because interest rates go low. Banks can't make money lending short or borrowing short and lending long when interest rates are so low, and that's really what's put a damper on financials getting a major rally. They too also topped early last year on both weekly 13 and 9. Just to show you, here's a 13.2 said upside exhaustion, and for months it's about as high as we went. So again, it's an important signal to understand, and why in the no trader issue we use, every chart we use has this on there for whatever particular stock, index, ETF we're looking at, because it gives us a very good clue about when to play the trend and when not to play the trend. As far as financials now, here's a flattening 50-week moving average. We're still above the 200-week moving average, which caught the lows all the way back on the lower left side of the chart a couple times, and then even the Christmas low. So kind of this 24-ish level, in case financials got down there, would be awfully important in the scheme of things. So other than the Christmas sell-off last year, the V-shaped bottom, the bulk of the action has really been kind of, we'll say, in this area. We're in the middle of it right now, so nothing of particular. There's no particular VIG here. You have an unfinished 13 count to the upside. You're currently in a setup down count to the downside. That makes it also very neutral. Let's see, is this still active? It is, no, it's not. So just behind this moving average, I see a little hyphen here in purple. They happen to be the same color. So that's a new propulsion sell level. So Friday closes under 26.65 that follow a week that had an up close. So let's say this Friday we close above last week's close. So we have an up close this Friday relative to last week. If then next week we close underneath this level, open lower the next Monday morning and take out this week's low, you've got a new sell signal for financials with a downside target of 24.59. We are still within an active upside propulsion signal that's been in place. So in a bigger picture, we have a 29.71 to 30.11 target here on the upside. So again, you're in the middle. You don't really have much of a bias here. The bias is to the upside just because of the thrust we got off of the Christmas bottom. So everything still points towards this moving higher. But at least now you also get a fairly tight stop, knowing that, again, if we get an up Friday close followed by a down Friday close underneath 26.65 with the following Monday morning gapping lower, you basically get a new sell signal for financials. Otherwise, I'd put these in the category of they're a hold with a minor upside bias. Industrials, XLI. You've got forget about the floating yellow circles here. They're just picked up from prior charts. So on the test of the all-time high from last year's, early part of last year in January, we get a 13.9 combination that leads into the fall's decline. Again, this is very similar to what we just looked at. Unfinished upside count, unfinished downside count, but holding the 50-week moving average. This, as of right now, we're trading above last Friday's close. If we close this week above 75.42, then next week close under 73.81 on Friday of next week and gap lower the next Monday morning and take out last week's low, you have a new sell signal with a target down here at 68.5-ish. Otherwise, let's see. You have a minor, very minor upward bias here. Otherwise, same thing. I mean, when you have a 50-week moving average that's pretty much as flat as this is, it's kind of telling you you've got no real direction here. So that's industrials. You'll see a lot of these don't really have real direction, and a lot of them have not taken out their highs from last year. Let's take a bunch of these ellipses off as we start looking at technology. So here's January of 2018. Nice call for exhaustion of trend. We sell off for a quick month and go sideways for a while. Unlike most of the charts we've looked at, tech has continued to the upside, made new all-time highs multiple times, made it in August of last summer, made it in April this year, and made it again this summer. This came with a sequential upside exhaustion signal. We've pulled back. Notice that this too has not been able to properly break its propulsion level on a weekly basis. Just like the S&P holding at 2880, this is doing the same thing at the 7811 level. So here's the way I look at this. If we close this week above last Friday's close, which right now we're easily doing, and then next week we close beneath 7811 and gap lower the next Monday morning, you have a new sell signal in the technology space with an initial downside target of 73.44, which is not a huge downside target, but it's still, that would be it. If the market really went down, the bigger downside target would be near 64. On the upside, we need to properly get above 81.44 on Friday closes to then say that we still continue higher for 87.75, and ultimately over 100 if that kicks in. Notice the propulsion exhaustion signal here in teal came off of this buy signal back in March. So when we properly broke through it, it said we would get to this level, and we got awfully close before this pullback, but we did actually get there. And we got to the target with the 13, which is, for me, a time to take profits. Both hitting, unrelated models give you the same. One tells you timing, one gives you a price level. Those essentially gave you at least some reason to take some off the table before what ended up being a fairly sharp 2-week decline. So long-term picture, obviously, energy still looks good. Semis are starting to look questionable. They're getting a lot of upside exhaustion signals on multiple time frames. So if you look at the stocks, I see 13s on even, I think the monthly chart has it, and the weekly chart has it. But tech is, to me, tech is still the place to be. And it's still an overweight, and I'm not willing yet to take it down from that. Also of importance this year is that equal weight tech is doing pretty well versus not equal, against weighted tech, which means it's not just a FANG rally. Here's Staples. Staples have made a new high. The defensive part of sector positively sloped moving averages, also failed to get a breakdown under 58.37. So if same thing, this week closes above 58.37, next week closes beneath 50. I'm sorry, if this week closes above last week's high and next week closes under 58.37 and gaps lower, then we have an issue on the downside that could take you down to the 50-week moving average. XLU, essentially on all-time highs here too. Watch last week's low. That is a key level. So Friday closes under 58.91 would be an issue at this point. Otherwise, they look good. XLV Healthcare made a new all-time high in November of last year, accompanied with a sequential exhaustion signal. So again, it's kind of sideways. Nothing much here that really gives me a real edge relative to other ones. Let's look at, I skipped XLRE. Notice you can't miss this. Only the second time it's had an exhaustion signal. This is the best performer this year. So despite that, we got very close to the full exhaustion level for propulsion. We've got a 13. I am not buying real estate names now. They've obviously done very well with interest rates going down. And let's take a look to finish up on consumer discretionary. Got to a 12 count. So we didn't quite hit the 13. Same thing here. Hasn't gotten the sell signal beneath the propulsion level. Up close this week relative to last week. If we close next week under 118, then and gap lower the following Monday morning, you're talking about a 111.40 target. So that's it for this week. Just be careful for some of these signals I've alerted you to, depending upon where we close this week, next week, and the following Monday. Contact me. It's Rick at inthenotrader.com. Check out our website, inthenotrader.com. This morning, a new video came out of me on Real Vision. So for those of you who are subscribers to that, check out that.